Own everything for $282.55. No, really. What's going on, guys? In this video, I'm going to show you the 2 index funds you need to own to have exposure to every single company in the entire world. Every single US company and every single international company out there can be wrapped up in just 2 low-cost index funds for a couple of $100. Now, why might we want to invest in these index funds when instead you could chase after these trillion-dollar companies like Facebook, Apple, Tesla, or Microsoft? Even though these 4 companies that you see can get you some pretty decent returns, or at least it's expected to get you decent returns, maybe you're trying to chase after the next big thing. You want to find the next Tesla or the next Apple, Facebook, or Microsoft, but there's only one problem. You could face problems like what Netflix recently faced this past week. Its earnings came out and it plummeted another 35% on top of its already downhill momentum. We're now down 67% in about 6 months. We wiped out 4 years worth of progress. Bill Ackman's probably crying somewhere in a corner, but this is a serious threat that we have as investors, especially when we're trying to cherry pick individual stocks. Just because it looks good on paper or just because it has had some great momentum doesn't mean it's going to keep growing, and you could have this big, ugly crash. And if you have an extremely concentrated portfolio, it could wipe you out. Now, yes, people have concentrated portfolios and make billions of dollars. I'm talking about people like Charlie Munger and Warren Buffett, and it's definitely possible to do. Meet Kevin on YouTube. He did that, but he recently switched over to a whole bunch of indexes now because he had his great run up. He made a lot of money on Tesla, but now he's thinking, okay, I made the money. Now let's try to protect it and play it safe. And as my portfolio continues to grow, I need to start changing my mindset and thinking, hey, now that I have some wealth, how do I start to protect that wealth? So the best way to do that is through diversification. And a famous American investor, John Bogle, who we will talk about a little bit more in a second, had this great quote that I love: "Don't look for the needle in the haystack, just buy the haystack." You may or may not know who he is, but he is actually the founder of Vanguard. So all of those lovely Vanguard ETFs that everyone talks about, he's the one who founded it. And I think this is a great saying. This sums it all up, and it's a great way to think, especially when you're looking to protect your wealth. And there's going to be 2 ETFs. They are Vanguard ETFs that will make up every single stock in the entire world that you can own for a couple $100. The first one is the VTI, which is made up of over 4,000 publicly traded US companies. So that is your first ETF. And your second ETF is the VXUS, which is made up of almost 8,000 publicly traded international companies. So you may be asking, what kind of companies are we looking at? Well, you probably know the US companies, and you probably know a decent amount of these international companies as well. Here's a breakdown of the top 20 companies. We got Apple, Microsoft, Amazon, Tesla, Google, NVIDIA, Berkshire Hathaway, Meta Platforms, United Healthcare Group. And then for the internationals, we got Taiwan Semiconductor Manufacturer, Nestle, Roche Holdings, Tencent Holdings, Samsung, ASML, Toyota, Shell, Astar, and BHP Group. Probably know maybe 17 of these 20 companies. And here's the top 20 breakdown. You may be thinking, wow, we're really concentrated in Apple, Microsoft, Amazon, and Tesla. And I'd throw Google in there as well. But this is just the top 20 holdings. If we throw in the rest, the other 12,000 companies, this is what the breakdown looks like. The top 20 holdings only makes up about a fifth of both ETFs, or 21.2%, a little over a fifth. And then you have the rest, the other 12,000 plus companies, making up almost 80% of the rest of the ETFs, or 78.8%. So this is a great way to diversify. And let's say something like Apple or Microsoft has a catastrophic failure and this ugly crash like Netflix did and is down 67%. You're not going to be feeling those effects as much as if you were to have a concentrated portfolio and maybe you only have 10 different stocks. So Apple or Microsoft would equate to 10, 12, or even 20% of your portfolio. Instead, it's only 4 or 4.5%, which is still a decent chunk, but you're going to be sleeping much better at night knowing only a couple of percentages are going to be knocked off of your entire portfolio, and you have the rest of the companies to bank on. Hopefully you have a new up-and-coming company that you don't even know about that will have massive appreciation over the years, and it will help these ETFs grow. And I just want to throw out there, this is not financial advice. This is purely for entertainment and education purposes only. But let's move on to the good stuff, like what to expect if you hold on to these two ETFs, like some dividend yields and that good stuff, and the sector breakdown. And before that, what kind of prices are we looking at? So let's look at the prices of both these ETFs. You have the VTI is $223.88 as I'm recording this, and the VXUS is $58.67 as I'm recording this. That's where I got that $282, less than $300, and you own every single company in the world, which I think is pretty cool. That's 12,082 companies. Now let's look into both the VTI and the VXUS so you know what to expect. So we're going to jump over to my favorite platform, Seeking Alpha. Grab your discount in the description, 50% off premium. This is the VTI, or Vanguard Total Stock Market ETF. And over the past 5 years, it has done really well, 84%. Very similar returns to the more common SPY. If we look at your S&P 500, you're looking at 88%. So it's roughly the same amount. If you actually go out more than 10 years, if you go out 20 years, the VTI has actually outperformed the S&P 500 just by a little bit. I have a video on that if you want to go digging through my channel. But these 4,000 companies, you're pretty much going to get a very similar return to the S&P 500. And it does produce a nice 1.32% dividend yield, which has been paying out consistently for a while now. So that is a nice added benefit. Now, we already went over the holdings, but just having different companies doesn't make it diverse. What makes it diverse is being in a whole bunch of different sectors. And this is the breakdown of the Vanguard Total Stock Market ETF. You can see a lot of it is in technology because right now tech has had some amazing run-ups the past decade, which we all know. But then you got a decent amount in healthcare, financials, consumer cyclical, your industrials, communications. Here's the entire breakdown. And again, you already saw the holdings. Your top 10 holdings makes up 24%. But then you still have over 75% wrapped up in the rest of the holdings, which is good to know. But let's jump over, what does the International Vanguard ETF look like, or the VXUS, Vanguard Total International Stock. Now, this is everything minus the US companies. So that's why it's not like you could just own this and you have everything. You need to own the VTI and the VXUS to own every company. And you can see that the returns are much more modest over the past 5 years, 18%. Over the past 10 years, only 31%. And if we go out max, only 15. I mean, we're really not looking at some major run-ups here. But that's not to say that we have a bright future. There's a ton of innovation going on in different countries like South Korea, Vietnam, India. India is going to be the new powerhouse in 20 or 30 years, in my opinion, and Mexico. So you have all of these different countries that are innovating like crazy, and they may add amazing value to the VXUS in the future. And even though the past 10 years really hasn't been spectacular returns, we don't know what the next 10 years looks like. The next 10 years, the VXUS could have a chart that looks very similar to the VTI's past 10 years, and vice versa. Maybe the VTI won't perform over the next 10 years as well. Maybe the US won't have these amazing growths that they've experienced over the past decade or even century. And what is nice to point out, you are getting a much bigger dividend yield, 3.27%. So even though you may not have as great appreciation, you flip on that drip, and then that 3.27% comes a long way as it compounds over time. And if we jump over to the holdings just to look at what we got going on, you can see it's a little bit different than what the VTI has. The biggest sector is actually financials, and technology isn't even the second biggest, but industrials is the second biggest. Then technologies, consumer cyclical, basic materials, healthcare. So it's a different breakdown than the VTI, but this video is all about diversification and showing you the highlights of diversification. So they definitely go hand in hand, a really nice pair to have, and it's less than $300 to own both. But guys, that's what I got for you. Let me know your thoughts on this video. If you have any questions, drop those comments below. And as always, I will see you in the next one.